All right, welcome everyone to our Momentum Multifamily Case Study event. We have Mandy and Brian here with us tonight, where they're going to be sharing a 53-unit JV deal that they recently did. So excited to have you guys with us. I'm going to turn it over to my co-host Dustin to give a quick intro, and then we'll get started from there.
Yeah, appreciate you guys presenting. I've gotten nice to meet you, Brian, but I've known Mandy, I think, for a few years now. So awesome to have you guys. And a JV isn't something that at least people within my circle do a whole lot of. So we're super curious to what you guys have to say, and we'll give the floor to you guys. Appreciate it.
Very cool. Dustin, yeah, thanks for having us. A little Midwest cross-pollination, never hurt anybody, I guess. But I'm McAllister. I am out of Chicago. I run a meetup up there. Met Dustin at some, networking event stuff, some of the seminars when the world used to be open. My investment firm is called Good Fortune Capital. And I primarily do small multis for various reasons, some of which we'll dig in here. And most recently, I partnered on this 53-unit joint venture with Brian Kochendorfer. I don't know why when I'm speaking live, I always mess you up, buddy, but tell us a little about you.
Thanks, Mandy. Dustin Hayden, great to be here. Great to see everybody. My name is Brian Kochendorfer.
I'd like to buy a vowel.
Also from Chicago. My background is as a multifamily broker, actually, for almost 15 years. I took a step back from that in the last year or so. I started off investing about 4 years ago in a couple passive deals, and then started acquiring deals on my own with a few different joint venture partnerships. So I've done everything in joint ventures so far. I've bought 340 units total, all in Indiana and Illinois, and this 53 unit was our last acquisition. So excited to talk about it.
Very cool. Well, let's see if I can figure out how to share my screen. Share screen. Perfect. She can be taught, people. Okay. Are we good? Can everybody see us here? Because I lost you all. Yes? Okay. So, part of, I know that we're coming to you from the land of, you are all in the land of everything, big apartment buildings, but, Indianapolis, I think it's kind of a little bit of a sleeper market that makes a ton of sense. So, we'll dig in a little bit to this kind of legacy cash flow idea that we took this property down with. So we'll talk a little bit of the investment philosophy, why the market, and then the strategy behind it that we think it might be a little bit different than other things that you've seen before. So Veranda is the name of the property. It was originally an assisted living facility that a group called Core Redevelopment repositioned into, mostly one bedroom and some studio apartments, 53 units, like we said. It's a very strong B area, I call it. It's very close. It's in the submarket of Speedway. So, the Indy 500, the Speedway there. An interesting piece of why we like that specific submarket is the actual track itself was recently acquired by the Penske family. So you've probably heard of Penske Auto. Well, they're going around, that family is investing in these track areas pretty heavily, and that is leading to a pretty significant improvement to those areas. So we really did enjoy that about this Speedway area in general. Brian, you have anything to add about Speedway or the property itself, Indianapolis?
Yeah, what was interesting about this too was that Speedway is kind of an up-and-coming market over the last few years. It's only about 10 or 15 minutes west of Indianapolis downtown proper. And as some of the properties have traded hands over the last 3 to 5 years, the area has gotten better and better, and the town has been putting some money into the main strip on there. So very attractive from a market standpoint.
Absolutely. And I mean, it's just like you'd look at any market. We're going to show you some stuff on the diverse employment. You wouldn't really think, if you don't know a ton about Indianapolis, I feel like Indiana is quite literally a quintessential flyover state, but there's a ton of big deal names big deal employers like Salesforce, lots and lots of hospitals in the area, lots of medicine stuff. Pharmaceutical companies like Roche and Lilly are based out of there. And if you've heard of Angie's List, they have that's where their home office is. So incredibly diverse employer base, and its unemployment is always very low. It has been historically very low in Indianapolis. So another reason that we think that this one trucks along and is kind of a supermarket in many ways. I believe CBRE is projecting a 4% rent growth year over year here for 2021 and ongoing. So, we like where things are going.
Yep. One thing I'll add is that Indianapolis is often considered what they call kind of a hybrid market, where it's not necessarily a heavy growth market the way that Atlanta or Phoenix is, where it's not getting those 6, 7, 8% rent growth each year or population growth, but it has steady job and population growth. As you can see here, it's very consistent. So you get the hybrid of growth as well as cash flow. And it's one of the few markets that you can get that in right now.
And I'll say too, coming from Chicago, that whenever I drive to Indy, there's all these billboards for, hey, people in Chicago, you don't know what you're doing running businesses with your government. Come to Indiana. We will help you run a business well. And that's really happening in a really big way. I'm seeing, like, even anecdotally, just friends move their businesses and their families out of state because, Illinois, I don't really trust Illinois. So I love that we have Indiana this close that we can continue to target. But, just like anything else, these demands lead us into a higher price per unit and growing historical rent. So, like CBRE is projecting, we're seeing pretty significant growth in those areas.
Yeah, I think this year is expected to be 4 to 4.5%, according to CBRE. And last year, in certain areas, it was 5.9%. So in certain pockets of Indy, you are getting that 4 to 6% growth. And even in the pockets that aren't as good, you're getting 3 to 4 consistently.
So for purposes of, this asset in particular, this is, kind of I wouldn't call it a counter way of thinking, but it is a little bit different. A lot of the larger syndications that I've seen friends structure, it was a 53 unit stabilized asset when we took it down. So, why did we choose that? We're seeing multifamily be very crowded. It's a crowded space. And, especially with COVID, lots of institutional money that was looking for offices has crowded into our space as well. So it's done nothing but get more crowded. So, Brian and I had some long discussions. We took a big step back and we decided, all right, what do we need? Like, what is it about multifamily real estate, number one, that we have to have, and number two, that we can't possibly give up? And number three, what does this market actually really have going for it? So, what do we need? We're both very, cash flow heavy focused rather than value add even. We're in this for the long game. That it's really nice in terms of value add to be able to capture that big pop in an NOI improvement and a disposition event. But if you buy and hold for a very long term, it's cash flow from day one that matters significantly more. Brian, you have commentary?
Yeah, and if you look at the timing we went under contract here, we put this property under contract in June, July of 2020. So we were coming out of that first few months of COVID. Things were just starting to open back up. And as much as we both like the value add type property, taking something with cash flow day one and hopefully some rent bumps along the way just seemed like a much better play than trying to buy something with a value add component, having to guess how many tenants you can get out to do renovations over the next 12 to 18 months, and then project where market rents are going to be when in that time, everything was so uncertain. So once we got down here, saw the property, saw how well maintained it was, and knew that there was some potential upside in rents without doing any actual work, it was just a no-brainer to pursue this.
Because if you think about it, you're not going to buy a value add property without paying for some of that opportunity to realize that value add, right? Like, you're not just going to look at an NOI, plug in a cap and pay that. That does not happen in our world. So, what would be more interesting to pay kind of almost full price and have this locked in. We have a historical data on that is achievable in terms of cash flow, or, take on a big, pretty heavy lift and hope that we have an opportunity to achieve that. So stabilize to scare us off. So, what can we give up? Ideally, going for 100 units makes a ton of sense. We would love to do that, but mom and pops are, operating in this fewer than 100 unit space. So, honestly, so long as we can get agency debt, this good long-term non-recourse debt, I'm interested. And honestly, if you need a loan balance of $1 million, personally, I think the sweet spot is, you need a loan balance of $1 million to get a Freddie small balance loan. That would mean purchase price around 1.3-ish. If you're looking at $75,000 a door, that's like a 20 unit that you're looking at in order to capture that lending. So, what is it that the market really has going for it, right? We're at crazy low rates. So if you can lock that in longer term in a place where we're going to have growth, it doesn't really matter what happens to the value of the property in most respects, because you're going to have that locked in debt for longer term, which we'll get into here in a little bit.
Yeah, and with the underwriting assumptions that we made, both for short and long term, I think we both felt really good about the prospects of this. And as we've already seen, we're getting, pretty significant rent bumps, 2 to 3% as units turn over. We underwrote 0 for the first 12 months, I believe. So yep. Ended up being, a really good play so far.
So that segues perfectly into, this unknown climate that we're in and how we chose to mitigate risk. So we'll go deeper into those underwriting assumptions. And I get all warm and fuzzy when there's a bunch of potential exits, so that we don't have to thread the needle on a business plan. It's a more buy and watch approach than buy and hold. And then I think it's totally worth diving into the loan that we ended up taking down. So Brian, you started talking about that underwriting criteria. Why don't you finish us off here?
Yeah, so some of the main things that we were looking at when we underwrote this was, one, we didn't want to assume for any growth year one. We wanted to underwrite it with the current rent roll in place and assume that was going to be the rent roll for the next 12 months. Second, we increase our vacancy to see how much we can increase it to where we can at least pay the debt and pay the bills. If I remember correctly, we were able to absorb about a 30 to 35% vacancy factor on this before we would be underwater. So if the property all of a sudden went a third vacant, we would still be able to pay all the bills and pay the debt. And that was our main thing, because again, just coming out of COVID, we knew there was a few tenants in there who had lost their jobs or who were, on furlough, working from home. We didn't know what was going to happen with any kind of government assistance for rent, or there's, in Indiana still at the time, the eviction moratorium. So we had a lot of different factors that we had to consider, and those were the main things that we wanted to look at to make sure we can still absorb this.
That break-even analysis was the very most important to me personally. And it was a 42% economic break-even that we could sustain not being underwater. And, I ended up this was actually the joint venture is Brian, me, and one more partner who is primary equity on the deal. So, he is active in the deal, but Brian and I do the heavy lifting largely. So that break-even analysis, our money partner, basically, he had the idea, we got to look at what they do for jobs. And my, economics part of my brain totally agreed that, you can figure out what these people do for a living. Largely the people who were losing their jobs were the ones who have, that are manicurists and waitresses, the people that have those types of jobs. The ones who are keeping their jobs are like computer programmers or sales reps or, nurses, police officers. So you can kind of get, and I would actually argue that the people who were losing their jobs are the type of careers that are kind of, renting a C-class asset. This was really a strong B-class asset. So what we did is we ended up going to the previous, then current property manager, got all of the applications for the current tenants. And I had just, a little pile. And I said, at-risk job, not at-risk job, at-risk job. And we ended up with, it was 15% or so had pretty significantly at-risk jobs with that break-even point of 42%. So, that felt to me like worst case scenario. that 15 or 20% lose their jobs and can't pay their rent. And this is a state where, we're still able to evict through all of this. So I felt super comfortable moving forward.
Yeah, being able to evict at that point was very, very important as well. I have properties in both Illinois and Indiana. In Illinois, to this day, we still evict 13 months post-COVID. We are not able to evict in Cook County, Illinois. In Indiana, they only put it on hold for about 90 to 120 days. And in my other property in Indiana, we only had to evict one person, thankfully, but we were able to start that process at the same time we were going through due diligence here. So that was a huge factor. I know you talked about potential exits a little bit. And, what we did on this deal was we put on actually a 15-year fixed loan, amortized over 30 years. We got 8 years of interest only at a rate of 3.68. Some people don't want to take that much interest only. We loved it because it was cash flow in a market that is going to continue to grow. So we feel like we're going to get appreciation. And one of the potential exits, and you can talk about the others, but one of the ones that I liked the most was most times when people put on Fannie or Freddie debt, they get a 10-year loan with 3 years of interest only. The downside to assuming somebody else's loan is that you typically aren't able to get any type of interest only because the borrower has already used it. Then they want to sell it and have somebody else assume the loan at that point. Well, in this particular loan, as long as there's 7 years left, somebody can assume the debt. So we can reevaluate this in 5 years, potentially sell it, in which there's 10 years left on the initial term at 3.68 with 3 years of interest only as well, which is what most people can get on a normal Freddie loan anyways. So that was one of the things that really pushed this in the yes category for me.
And you can't convince me that in 5-7 years that 3.68 isn't going to at least be somewhat attractive. Looking at deals right now that have like a 4.5% loan that they want you to assume, that's not going to happen. But how much lower can we go? And I mean, who knows? But 3.68, I've got to imagine will at least be attractive in a few years. My favorite potential exit, it's like having a favorite kid. You always do for your parents out there. You have a favorite kid, just don't tell them. My favorite is this supplemental loan idea. This chance to bolt on an additional, like if we do see significant appreciation in 5 years, we're able to put on another debt instrument to take out most of what it is that we put into this deal. And I think the thing that's worth talking about here is, all of this stuff, it matches the goals of team. If you're going to have a long-term hold that's cash on cash heavy, it's important to understand that your IRR is not going to look like what it would if you had a 2-year exit when you boosted NOI by a pretty significant amount in that frame. So understand that this met the goals of our team and was very cash flow heavy.
Yeah, and just to kind of add on to that, the cash flow that we're going to achieve year one is in the 9.5% to 10% range. We've already started reading. I think we've made 1 or 2 distributions so far, and we're on pace today to be between 9.5% and 10% over the first 12 months. So that's pretty tough to cash flow in a first 12-month period with any type of deal. And it was just those things where all the stars aligned on this one. And, I'm okay taking a lower IRR for that kind of cash flow right now.
Absolutely. And we kind of dug into this, but it was a Fannie product. You can't do a supplemental on a Freddie, anyway, so it was a Fannie product. So we thought it might also be interesting because I always love to see how operators, the stuff you look at to really, manage. You can't manage what you don't measure. So, what are you measuring? What sort of reports are you looking at? So this is actually just a couple screenshots from a weekly report that Brian and I and our team received from property management. Brian, do you want to talk a little to it?
Yeah, so the top part is just, it's a little bit hard to see, but you can see the unit composition. It shows how many units there are total, how many are occupied, how many are leased waiting move-in, how many are vacant and not ready, then how many are vacant and ready. So this report was from last week. It's 53 total units. We had 51 occupied, 1 leased that was moving in, I believe 415, and then 1 unit that just moved out that they're doing the turn right now, should be ready by May 1st. The delinquency, it's very low here. So you can see I think the charged rent was 40,009 something, and then the collected was 40,009 something. So for January, we collected 100%. For February, looks like we were at 96%, I believe, and March 96.4% looks like. So.
Yeah, so it's always the one bad apple, So, we always watch the collections and occupancy, and this is just something that, Yardi, we've asked that Yardi automatically send to us every week. I'll say even though this was a stabilized asset, we were on the phone with property manager working through these reports and other things bi-weekly until just like this coming month. We'll be meeting monthly. So I don't know. I always like to know what operators are looking at. Brian, you have anything on this?
Yeah, regarding the management calls, even on a stabilized property, I think we both thought it was important to maintain that communication level where we're talking twice a month. Sometimes these calls were 5, 7, 10 minutes most, but we just want to get an idea for how things are going at the property. We get down here about once a month, but how things are going at the property, any issues, any problems with tenants. And we also wanted to track what the maintenance issues were. Mm-hmm. What are the biggest maintenance issues that you guys are having right now? And what can we do to help make those better going forward? So one issue that we had was this has in-unit washers and dryers, but it's a washer and dryer combo unit. So as also on these weekly reports that we get, I don't think you have a screenshot here, but it shows what work orders we have each week. So we can track what work orders are coming in to the management company. And we were noticing repeatedly that there was washer and dryer issues. And these are brand new machines. And then they figured out after going to several of them that it was really just how people are using them and that they're not cleaning out the vents. So now all we did, Mandy, was just have the management company give them a little how to use this machine pamphlet on new lease move-ins. And those are having far fewer problems than the existing tenants were.
And they know now how to proactively service them on move out because a lot of it had to do with, traps, the lint traps and proactively making sure that they're working out. But I feel like, this is one of those things that ounce of prevention is better than the pound of cure. And, pushing our property manager to look at that stuff to help us in that way was what got us there on the washer dryers. And oh, by the way, if you can do a washer dryer not combo unit, I would probably vote for that for you and whatever building you're going to do. They're pretty interesting, but yeah, they're a little troubling. But anyway, this is, in terms of the joint venture structure, in terms of this deal being stabilized and cash heavy, kind of a more legacy type asset, it aligned with our team's goals. The joint venture structure really worked for us because we had one money partner who wanted to place a solid amount of capital. So rather than do, a large raise, we just brought him in and kept him active, involved him in a lot of the communication and decision-making. He's involved in all of that. So it really worked for this. And that's how we're looking to structure some future deals too, specifically this Indianapolis area. So my contact information is here. Would love to chat Midwest, would love to chat small multis, which are really my wheelhouse, with anybody who is interested. Bye.
Likewise, I'll contact info up here. Love to connect with people and happy to take any questions if you guys have them.
Awesome. Really appreciate you guys.
Great job, guys.
Do that.
Appreciate that. If anybody has any questions, be sure to put them in the chat on that right side. Curious, I guess I have a question. So is your money guy wanting to be more involved kind of for the tax purposes and all that, or is that just kind of how he or she is interested in being involved?
Yeah, it's somebody that I've known for 5 or 6 years now. We built up a pretty good relationship. I actually met through my brokerage career and showed him and his wife several properties over the years. And I started helping him evaluate some things that my company wasn't involved in. So we just built up a really good relationship. And, I started realizing that as he was a longtime developer, specifically hotels, And as he was getting out of that business and starting to sell off some of his hotels, he had a lot of extra capital to place, and he was just hoping to spend more time with his family and travel more, place some capital, but he's always been a very hands-on investor. He has never been one to just, he's put money in a couple funds, but for the most part, he likes to be hands-on with the physical properties. So, and this was actually the second deal that I worked with him on, and just in talking with him, he mentioned that he had some money to place. He would actually like to be the solo primary investor, but he would love if, we can help find him some properties. We can run the deals. We can take acquisition, asset management fees, invest our own capital as well. And then he would just be on as an active partner instead of a passive partner. And for him, the tax benefits are huge. So it really is kind of a win-win for everybody.
Cool. Awesome. Is it, I guess, is just kind of a TIC formation, or is it just a typical LLC and then you guys are all members, or how does that work?
Yep. It's an LLC with all members.
Okay. Cool. Okay.
And Mandy, you'd mentioned that you guys are looking to do more of these JVs. Are you guys going to do syndications too, or are you guys strictly focusing on JV?
I mean, I really love how nimble a JV is. And, a lot of the relationships that we've been developing with capital are larger investor folks who come from other asset classes like hotels or industrial or, large business owners that are going to have a disposition event in those businesses that want to be able to take down larger multifamily debts. But, you got to have had agency debt in order to get it. So, that's kind of how we're helping them. And I do think the deals to be had are going to be in this smaller this 50, call it 5 to 50, which is what I'm developing as my go-to. That's where mom and pops are. We've got a lot of eyes 100 plus. So the better we can get at, figuring out economies of scale on this small stuff and making them really hum. I feel like that suits the capital structure that we're going to have and also where the deals are going to be.
Cool. And I don't know if, and maybe I missed this, is this marketed or was this off-market deal or?
Yeah, so it was an on-market property through one of the primary brokers down there. And we had closed the transaction with the same broker about 6 months prior. So my main contact, they gave me a heads up a week or two out saying, hey, this deal's coming out. I think you might like this one. As it got closer, we were one of the first ones to tour. And they went through the process. Again, at the time, everybody's looking for 100 plus, like Mandy mentioned. So this wasn't getting as tours as they thought. And it came down to us and I believe 2 other buyers. But we were the only ones who had closed with this brokerage company before. And the deal that we closed on time and at the contract price. And when it came down to it, I think they had identical offers price-wise, or maybe within a couple thousand of each other. And they chose us because of our track record with that group. So anytime you're working with a newer broker, it's really, really important to do your best to close on time at contracts, because that will help you get other deals going forward. Because any seller is going to ask that broker, what's your history with them? Did they close? Did they come back and ask for a credit? Did they retrade? All that kind of stuff. So it was on market through a broker, but our prior experience with that broker certainly helped get us across the finish line.
Cool. I hope Miriam had that question about the acquisition story. So I was hoping that let me know if that kind of helps answer your question, Miriam.
We can always send the replay too, just so we don't repeat for everybody else too. So we'll be sure to send out the replay to everybody. But yeah, if there's any additional questions, be sure to drop them in the chat. Everybody's got Mandy and Brian's contact info, so you can contact them if they come up a little bit later.
So are you guys are concentrated on Indianapolis, or are you looking at any other? Are you looking at Illinois at all, or not so much?
Me. Brian's a different story because Brian's brokerage. So like he knows things that I do not know about Illinois, but I do not trust Illinois as far as I can grow it. So I'm actually selling absolutely everything I own here and getting the heck out of Dodge. So I'm very, I have some 1031 funds right now I'm looking to place in Northwest Indiana or Indianapolis. I think I prefer central Indiana to northwest Indiana, but either work for me. Right?
I'm still doing some smaller stuff, 10s and 20s in the suburbs of Chicago. I have a couple of good friends of mine are local property managers here. They own 500 or 600 units. I have a handful of buildings with them. So we do some stuff together, but I think the primary going forward is Indiana. And we've looked at some stuff in Columbus and Cincinnati recently. So we're hoping to, start to expand out there as well. We're building our property management and broker connections out there as we speak. And hopefully we'll, be able to take something down the next 6 to 8 months.
Mm-hmm.
Cool. Okay, awesome.
And we're not against syndication. I feel like the JV structure that we've found here is so much more nimble and works for these smaller properties. I will say, I feel like these smaller properties work when you can get down there frequently. To set it and forget it kind of might work with a larger property, but you certainly need to be more hands-on with ones.
Yeah, the fact that this was 3 hours away was a pretty important factor. And with syndication, we've run several models for syndication the last several months. It's just tough to make them work. The returns are getting tighter and tighter, I feel like, because a lot of the larger capital groups out there who don't have, a lot of the REITs, they're now coming down into this mid-market space, and they just need 5% returns. So it's just really hurting the yield on some of these mid-market properties. And I feel like where you have to shave off, the investors aren't going to take that much less. So you just have to shave off from the syndicator side and, hope it goes well and hope you get paid 5 or 7 years when you exit.
Yeah, it's definitely getting tighter. I think, we, at least, Hayden and I really focused on, before we even look at the numbers, we're looking at the location. We make sure we're super comfortable with the location because, as you guys are longer term, but you're potentially, not. We make the dating analogy or marriage analogy pretty often, but you're in a long-term relationship not only with your partners but with the property as well, and so you better make sure it's a good one. Well, cool. I don't think we have any other questions, so we'll go ahead and kind of flip over to the networking session. And so what we'll do is I'll press end session and it'll go to the lounge. So if you just pick a table, it's just like a breakout session on Zoom, and it'll look just like this, and you'll be able to talk with everybody. So see you over there.
Thank you.